Market Wizards by Jack D. Schwager. Introduction. Imagine for a moment that you could turn a $30,000 loan into $80 million. Not over a lifetime, but through a series of bold, calculated decisions in the world's financial markets. It sounds like something out of a movie, doesn't it? A fantasy. But the man who did it is real. And he's not alone. There exists a small, almost mythical group of people who seem to have mastered the art of the market. They're not your typical Wall Street executives in stuffy suits. Many of them work from quiet offices, far from the noise, and they've achieved a level of success that most people can only dream of. What separates these legends, these market wizards, from the millions of others who try and fail? Is there some secret formula, a hidden code in the market's movements that only they can see? For years, that was the question that haunted a man named Jack D. Schwager. Schwager wasn't just a curious outsider, he was a trader himself. And like so many others, he had felt the sting of failure. He'd done his homework, he'd analyzed the markets, and he'd still managed to wipe out his account, more than once. He knew that simply being smart wasn't enough. He had a graduate degree, a deep understanding of economics, but the market didn't seem to care. It was a humbling, painful experience. But instead of giving up, Schwager became a seeker. He embarked on a quest to find the answers, not in textbooks, but in the minds of the world's most successful traders. He managed to get past the gatekeepers and sit down with these intensely private, legendary figures. He interviewed the man who turned 30,000 into 80 million. He talked to a fund manager who achieved 5 consecutive years of triple-digit returns. He sat with a trader who started with just a few $100s and became one of the most powerful forces in the bond market. The result of that quest is the book we're going to explore today, Market Wizards. This isn't just another book about investing. It's a journey into the psychology of winning. What Schwager discovered, and what we're going to uncover together, is that the secret to their incredible success wasn't a magic formula. It had almost nothing to do with their specific methods. Some were mathematicians who relied on computers, others traded purely on gut feel. Some held positions for years, others for only a few minutes. The secret, he found, was in their attitude. Their discipline. Their unwavering control over the one thing they could control, themselves. So, if you've ever wondered what it truly takes to succeed at the highest levels, not just in the market, but in any high-stakes endeavor, then stay with me. Because by the end of our journey today, you'll understand the timeless principles of risk, discipline, and mindset that turn ordinary people into legends. You'll have a roadmap, not of secret trading strategies, but of the psychology that underpins all great success. Book summary. Our story begins where most trading journeys do, with a painful, humbling, and almost comical dose of failure. Before they were legends, the market wizards were just like everyone else. They were novices, filled with confidence, and they made mistakes, big ones. Take Michael Marcus. Here's a man who would later become one of the most successful traders in the world, multiplying a company account by 2,500 times over 10 years. But his career didn't start with a bang. It started with a fizzle. As a young man, a friend named John promised him he could double his money every 2 weeks, like clockwork. Marcus, bright but naive, gave him $1,000 he'd saved up. He didn't even ask how his friend planned to do it. The idea was so attractive he didn't want to spoil it with too many facts. He describes his first trip to a brokerage house like a wide-eyed kid visiting a cathedral. The mahogany desks, the hushed, reverential tone, the giant board on the wall with clicking prices. It was all so exciting. He and John even brought binoculars, like they were at a horse race. Then, a voice came over the loudspeaker recommending a trade. Marcus looked at his advisor, John, expecting to see a look of calm confidence. Instead, John turned to him and asked, "Do you think we should do it?" In that instant, Marcus realized his expert guide knew nothing at all. They took the trade. Almost mystically, as soon as their order was filled, the prices on the big board started clicking down, down, down. They lost $100. Their next trade was in corn. The outcome was the same. Their third trade, in wheat, didn't work either. They started measuring success by how many days it took them to lose their money. The final, devastating blow came from a can't-lose trade John had devised. It was a spread in pork bellies that he claimed was a guaranteed profit. They put the trade on and, for the first time, felt confident enough to go out to lunch. When they came back, Marcus's account was almost completely wiped out. He would never forget the image of his friend, pounding his fist on the quote board, shouting in frustration, "Doesn't anyone want to make a guaranteed profit?" It turned out, John didn't understand that the two pork belly contracts weren't deliverable against each other. The logic of his guaranteed trade was flawed from the very beginning. Marcus was wiped out. He fired John, scraped together another $500, and promptly lost that too. His first 8 trades were all losers. You'd think he would have quit. You'd think the message was clear: this isn't for you. But it wasn't. For Marcus, and for nearly every great trader Jack Schwager interviewed, this initial failure was not a stop sign. It was tuition. It was the price of admission to a deeper understanding. The author, Jack Schwager himself, tells a similar story. Armed with his graduate school education in economics, he was convinced he could predict the markets. He did a deep analysis of the cotton market and concluded that prices, then at 25 cents a pound, were headed higher, but would peak around 32 cents. The market moved up, just as he predicted. As it approached his target, he confidently went short, expecting the price to fall. For a moment, it did. He felt a rush of elation. He had outsmarted the market. But his victory was short-lived. The price quickly rebounded and then began a relentless climb. 32 cents, 33, 34, 35. He held on, convinced his analysis was right and the market was wrong. Finally, with his entire account wiped out, he was forced to liquidate his position. That devastating loss was one of the luckiest breaks of his life. Because cotton didn't stop at 35 cents. It didn't stop until it hit 99 cents a pound. Had he started with more money, he would have lost it all. These stories aren't unique. Almost every trader Schwager interviewed had a going bust story. A time when they lost everything, or came perilously close. A time when their ego, their certainty, and their lack of respect for the market's power led to disaster. Paul Tudor Jones, a trader of almost mythical status, tells of a cotton trade in 1979 that nearly broke him. He was young, successful, and feeling invincible. He put on a massive long position, an act of pure bravado. In an instant, watching the other traders in the pit, he realized he had made a catastrophic mistake. He saw that the market was going straight down, and that it was my blood that was going to carry it there. He lost 60 to 70% of his clients' equity on that single trade. He was so demoralized he almost quit the business. So what separates these men from the countless others who have similar stories, but whose stories end there, with failure? It's what they did next. For Paul Tudor Jones, that near disaster was a cathartic experience. He said, "I went to the edge, questioned my very ability as a trader, and decided that I was not going to quit. It was at that point that I said, Mr. Stupid, why risk everything on one trade? Why not make your life a pursuit of happiness rather than pain?" From that moment on, his entire approach changed. He became, in his words, more defensive. He said, "I am always thinking about losing money as opposed to making money." This is the first great secret of the market wizards. Their transformation from gambler to professional began the moment they stopped focusing on how much they could make and started focusing on how much they could lose. It began with the supreme importance of risk control. You see, the average person walks into the market thinking about the reward. They see a stock moving and they dream of the profits. They see a headline and they imagine getting rich. But the wizards, they do the exact opposite. Before they even think about the potential gain, their first and most important question is always, where am I getting out if I'm wrong? Larry Hite, the founder of Mint Investment Management, a firm that manages over $800 million, puts it this way. He tells the story of meeting one of the world's largest coffee traders, a man who knew everything about coffee, where the boats were, who the ministers were, everything. The man asked him, "Larry, how can you know more about coffee than me?" Hite replied, "I don't know anything about coffee. I don't even drink it." "How do you trade it then?" the man asked, bewildered. 5 times Hite was asked, and 5 times he gave the same answer: "I just look at the risk." 3 months later, that coffee expert blew $100 million in the market. He knew everything about coffee, but he didn't respect the risk. This isn't just a vague philosophy. For the wizards, it's a set of hard, unbreakable rules. Larry Hite's #1 rule at his firm is, never risk more than 1% of total equity on any single trade. Think about that for a second. If you have a $100,000 account, you would never risk more than $1,000 on any idea. By doing this, Hite says, I am indifferent to any individual trade. The emotional attachment is gone. No single trade can ever knock him out of the game. Michael Marcus, after his own painful lessons, arrived at a similar rule. Always bet less than 5% of your money on any one idea. That way, he says, you can be wrong more than 20 times. It will take you a long time to lose your money. For Paul Tudor Jones, it's a daily practice. Every day I assume every position I have is wrong, he says. I know where my stop risk points are going to be. I do that so I can define my maximum possible drawdown. This is the bedrock of their success. It's not about being a genius who is always right. It's about creating a structure where being wrong doesn't hurt you. In fact, William O'Neill, the founder of Investors Daily, says you should be able to win even if you are right only half the time. The key, he says, is to lose the least amount of money possible when you are wrong. His personal rule? He never loses more than 7% on any stock he buys. If it drops 7% from his purchase price, he sells. Automatically. No hesitation. No second guessing. He says, letting losses run is the most serious mistake made by most investors. This single idea, cutting losses, is repeated like a mantra by almost every trader in the book. Ed Sakota, a pioneer of computerized trading systems, was asked to list the elements of good trading. His answer was simple. The elements of good trading are 1. Cutting losses, 2. Cutting losses, and 3. Cutting losses. If you can follow these 3 rules, you may have a chance. This obsessive focus on risk control is what allows them to survive. But survival is not the same as massive success. Cutting losses prevents you from going broke, but what allows you to make a fortune? It's the other half of the equation, the second golden rule that is just as important. Let your profits run. Michael Marcus stressed this point, saying, if you don't stay with your winners, you are not going to be able to pay for the losers. It sounds simple, but in practice, it's one of the hardest things for a human being to do. Drive. Van K. Tharp, a psychologist who has studied thousands of traders, explains why. Our brains are wired in a peculiar way. We are, he says, risk-averse when it comes to profits, and risk-seeking when it comes to losses. What does that mean? It means when we have a profit, our first instinct is to grab it before it disappears. We prefer a small, sure gain over the chance of a larger, uncertain one. But when we have a loss, our instinct is to hold on, hoping it will come back. We prefer the gamble of breaking even over the certainty of a small loss. In other words, our natural instincts cause us to do the exact opposite of what we should. We cut our profits short and let our losses run. The wizards have learned to override this programming through sheer discipline. They have the courage to hold a position, to sit through corrections, as long as their original reason for the trade is still valid. Richard Dennis, a legendary trader who turned a tiny $400 stake into a fortune estimated around $200 million, says that 95% of his profits have come from only 5% of his trades. Think about that. Just a handful of massive, home-run trades were responsible for nearly all his wealth. If he had cut those winners short, his entire career would have looked completely different. This leads to the second great secret of the market wizards. They all found a trading methodology that worked for them, and they developed the discipline to follow it, no matter what. What's fascinating is that their methods are wildly different. There is no single right way to trade. Michael Steinhardt, a hedge fund manager with a phenomenal long-term track record, bases his entire philosophy on what he calls variant perception. He tries to develop an idea about a company or a market that is fundamentally different from the consensus view. For example, when everyone was enthusiastic about the biotechnology company Genentech and its new drug, TPA, Steinhardt developed a variant perception that the drug would eventually be a minor product. He went short the stock and stayed short for a year and a half, even as it went against him and he lost a lot of money. But he held on, because his fundamental view hadn't changed. Eventually, he was proven right and the stock collapsed. He doesn't use charts. He doesn't use stop-loss orders. His approach is deeply analytical and contrarian. On the complete opposite end of the spectrum is Ed Seykota. Seykota is a trend follower. He believes life itself is based on trends. He says, birds start south for the winter and keep on going. He developed some of the first computerized trading systems to identify and follow trends. His approach is almost purely mechanical and technical. He says that, on balance, his fundamental ideas have probably cost him money. Then you have someone like William O'Neill, who developed a very specific, hybrid approach for picking winning stocks. He calls it CANSLIM. Each letter stands for a key characteristic. For example, C is for current earnings per share, which should be up dramatically. A is for annual earnings growth. N is for something new, a new product, new management, or a new high in the stock price. He combines strong fundamental criteria with technical timing, buying stocks only as they break out to new highs from a solid price base. And then there's James B. Rogers Jr., co-founder of the legendary Quantum Fund. His approach is different still. He is the ultimate patient investor. He says one of the best rules is to do nothing, absolutely nothing, unless there is something to do. He says, I just wait until there is money lying in the corner, and all I have to do is go over there and pick it up. I do nothing in the meantime. What is that money lying in the corner? For Rogers, it's a combination of deep value and a catalyst for change. He bought German stocks in 1982, not just because they had been stagnant for 20 years and the German economy had boomed, but because there was a catalyst, an upcoming election that he believed would bring in a pro-investment government. He also has another specialty: buying value and selling hysteria. When a market gets into a panic, a frenzy, he starts looking to go the other way. He famously shorted gold in 1980 near the very peak of its historic blow-off. When asked why, he said he recognized the fingerprint of hysteria. The chaos was something that simply couldn't last. So you have a fundamental contrarian, a computerized trend follower, a stock-picking specialist, and a global macro investor who waits for hysteria. Their methods couldn't be more different. Yet they are all wildly successful. What does this tell us? It tells us that the specific methodology is not the secret. The secret is finding a methodology that you believe in, that fits your personality, and then having the supreme discipline to execute it flawlessly. Marty Schwartz, a trader who went from losing money for a decade to becoming a champion trader, tells a story that perfectly illustrates this. For 9 years, he was a fundamental analyst. He was smart, he worked hard, but he consistently lost money. He was, in his own words, always broke. Then he made a complete transition. He abandoned fundamentals and immersed himself in technical analysis. He subscribed to newsletters, he studied charts, he developed his own indicators based on moving averages. And he started winning. Consistently. Was it because technical analysis is inherently better? No. It was because technical analysis was the right approach for him. It fit his mind, his temperament. But changing his method was only half the battle. The other half was a change in his psychology. He says, "I became a winner when I was able to separate my ego needs from making money. When I was able to accept being wrong. Before, admitting I was wrong was more upsetting than losing the money. When I became a winner, I said, I figured it out, but if I'm wrong, I'm getting the hell out, because I want to save my money and go on to the next trade." That shift, from needing to be right to needing to win, is the psychological leap that every great trader has to make. It requires humility. It requires discipline. It requires an almost ruthless honesty with oneself. And it requires an incredible amount of hard work. This is another common thread that runs through the book, shattering the myth of the trader as a high-rolling gambler. These people are not just lucky. They are obsessive. Marty Schwartz still puts in 12 hours a day, calculating his ratios and posting his own charts. "My attitude is that I always want to be better prepared than someone I'm competing against," he says. David Ryan, a young trader who won the U.S. Investing Championship 3 times with triple-digit returns, describes his process as a treasure hunt. When he started out working for William O'Neill, he would take charts home every night and on weekends. He studied historical models of great winning stocks to ingrain in my mind what a stock looked like before it made a major move. He keeps a detailed diary of every trade, writing down his reasons for buying. He says, "The more disciplined you can get, the better you are going to do in the market." Brian Gelber, a dominant trader in the T-bond pit, says he talks to about 25 other traders every day. He is a great listener, constantly gathering information, trying to gauge the mood and position of the other players. The work is relentless because the market is a relentless and unforgiving opponent. The wizards know that their edge doesn't come from a one-time flash of genius. It comes from daily preparation. It comes from showing up, day after day, and doing the work. This dedication allows them to develop a deep, almost intuitive feel for the markets they trade. Tom Baldwin, the single largest trader in the T-bond pit, describes it this way. When he started, with no experience, he just stood in the pit for 6 hours a day, every day. He said, "I would see the same scenarios develop over and over again." He didn't need a formal education in trading. He learned by total immersion, by paying absolute attention, until the patterns became second nature. This brings us to one of the most profound ideas in the book, a concept that ties everything together: psychology. Jack Schwager's journey led him to the conclusion that attitude was more important than approach. But what is the right attitude? What is the psychology of a winner? Schwager interviewed 2 men who specialize in this very question. Drive. Van K. Tharp, a research psychologist, and Ed Sakota, the brilliant trader who became a mentor to Michael Marcus. Drive. Tharp has developed a test that measures winning and losing traits. The profile of a losing trader, he says, is someone who is highly stressed, has a negative outlook, has a lot of internal conflict, and blames others when things go wrong. They are impatient and want action now. Winners, on the other hand, are different. They believe money is not the most important thing. Trading well is. They believe it is okay to lose. In fact, they accept losses as a part of the game. They see trading as just that, a game. And because they've done their homework and mentally rehearsed, they have a quiet confidence. They believe they've won the game before they even start. Perhaps the most crucial trait, according to Tharp, is that winners take responsibility for their results. Losers blame the market, their broker, the insiders, anything but themselves. When a winner has a losing trade, they don't blame. They ask, "What did I do wrong? What rule did I break? How can I avoid making that same mistake again?" This ownership of results is the key to growth. Ed Seykota takes this idea a step further into a realm that is almost mystical. He has a phrase that echoes throughout the book, a statement so simple and yet so profound that it forces you to re-examine everything you thought you knew about success and failure. He says, "Win or lose, everybody gets what they want out of the market." At first, it sounds absurd. Who wants to lose money? But Seykota explains. Some people, he says, seem to like to lose. They win by losing. He tells the story of a trader he knew who would build a small stake of $10,000 into $250,000, over and over again. And then, like clockwork, he would change his personality and lose it all back. Why? Because on some subconscious level, he was getting what he wanted. He got the excitement of the game. He got to be a martyr. He got sympathy from his friends. He got to be the center of attention. Seykota believes that if people look deeply enough into their trading patterns, they will find that, on balance, they are getting what they want, even if they don't want to admit it. This is perhaps the ultimate lesson of the market wizards. The market is a mirror. It reflects your own psychology back at you. If you are undisciplined, the market will take your money. If you are driven by ego, the market will humble you. If you have unresolved psychological conflicts, the market will expose them. The journey to becoming a great trader is not about mastering the market. It is about mastering yourself. It's about developing an unwavering belief in your method, while having the humility to know you can be wrong. It's about having the conviction to hold on to a winning trade, and the discipline to cut a losing one without a second thought. It's about doing the hard work, day in and day out, to be better prepared than your competition. And it's about understanding your own mind, your own fears, and your own desires. The wizards are not supermen. They are people who have confronted their own flaws and weaknesses in the harsh arena of the market, and have emerged stronger, wiser, and more disciplined. Their stories teach us that success is not a gift. It is a skill. And like any skill, it can be learned. Commentary. As we come to the end of our journey through Market Wizards, it's easy to feel a little overwhelmed. We've met so many brilliant minds, each with their own unique style, their own complex strategies. But if we take a step back, what is the single, most powerful lesson we can take away from all of this? For me, it's the profound realization that there is no holy grail. There is no magic formula for success, in the markets or in life. The persistent search for that one secret indicator, that one perfect strategy, is a fool's errand. The book is a powerful testament to the idea that how you trade is far less important than how you think. The common denominator among these legends is not their method but their mindset. It's a mindset built on a foundation of almost paradoxical qualities. They have supreme confidence, yet they are deeply humble. They know they can win, but they are also acutely aware of how easily they can be wrong. They are incredibly aggressive when they have an edge, but they are obsessively defensive when it comes to protecting their capital. They are disciplined rule followers, but they are also flexible enough to know when the game has changed. This isn't just a book about trading. It's a masterclass in applied psychology. It teaches us that the greatest obstacle to our success is usually ourselves, our ego, our fear, our impatience, our natural human tendency to avoid small pains, which often leads to catastrophic ones. So, how can we start to apply these powerful lessons in our own lives, starting today? You don't need to open a brokerage account or have millions of dollars to begin thinking like a market wizard. Here are 3 simple, practical actions you can take. First, start a decision journal. Whether you're making investments, career choices, or even personal decisions, do what David Ryan does. Before you act, write down exactly why you are making that choice. What are your assumptions? What do you expect to happen? This simple act forces clarity. More importantly, it creates an honest record that allows you to learn from both your successes and your failures, without the filter of a faulty memory. Second, embrace the 1% rule. This is Larry Haitay's cornerstone principle, but it applies to so much more than money. In any new venture, in any risk you take, ask yourself, am I betting the farm, or am I betting just 1% of my emotional and financial capital? By keeping your bets small, especially when you're starting out, you give yourself the greatest gift of all, the ability to survive your mistakes. You stay in the game long enough to learn how to win. And third, learn to do nothing. This might be the hardest advice of all in our hyperactive world. But as James Rogers so wisely points out, most of the time, the right action is no action. Resist the urge to constantly be doing something. Instead, cultivate the patience to wait for the truly great opportunities, the ones that feel like money lying in the corner. Whether it's an investment, a business idea, or a relationship, the best opportunities are often the ones that don't need to be forced. They feel clear, obvious, and right. Ultimately, the message of Market Wizards is one of profound optimism. It tells us that extraordinary success is not the exclusive domain of the gifted. It is the result of discipline, hard work, and, most importantly, a relentless journey of self-discovery. The market, in all its brutal honesty, is simply a powerful mirror. It shows us who we are. And the greatest traders are those who have the courage to look into that mirror and never stop working to become a better version of themselves. That was a journey into Market Wizards by Jack D. Schwager. We've touched on some of the core principles today, but I hope you can feel that there's so much more depth to these stories. A summary is like looking at a map of a beautiful country, but reading the book is like taking the journey yourself. It's in the personal stories, the moments of despair and triumph, that the lessons truly come alive. This summary is just here to show you what's possible. If any of these ideas about discipline, psychology, and risk have sparked something in you, I encourage you to pick up a copy. Reading it isn't just about learning to trade, it's an exploration of the mindset of excellence, and it might just change the way you approach every challenge in your life. You can find a link to the book in the description below. Also, if this exploration has brought you any value, a simple click on the like button and subscribing to this channel would mean the world. It helps us continue to bring these powerful ideas to more people. Let's keep exploring the wisdom of the world's greatest minds, together.